Hi, this is Todd with a Q3 market update. I'm going to move quickly through these slides to try to give everybody a background what's going on in the markets and the world today with the increased volatility. So that's designed for clients and also for investors who try to do it themselves. Normally when I talk to people about retirement and the paths they have today, there's really three solid options. Save more, and we recommend that clients be saving about 20% or so of gross income. Invest better, which we'll get to in some other slides, but we believe in low cost, highly diversified investing with factor tilts towards value and small cap and profitability on a global basis. And the third option for a lot of people, sadly, is going to be they're going to end up retiring later than they think and possibly working into their 70s or so to be able to maintain their lifestyle in retirement. Here are 5 keys to success in the rest of 2014 and 2015. Number one, I've been saying this for a while, is expect more volatility in the markets. We've had a long period of very low volatility, and it's increasing now, and we'll give you some key drivers for that. But it's very normal for markets to go up and down in a quarterly basis or yearly basis. Focus what you can control, saving, spending, your job, family, and your health. Save more. That's very important for dollar cost averaging and for continuing to buy the market at lower prices. Track your spending. We suggest that clients use mint.com. It's free and it's very robust to help track some of your monthly spending. And then to keep track of the bigger picture, your net worth with a goal for what you need for retirement. And we can certainly help in this process. Okay, right now in the markets, there's certainly plenty of things to worry about if you've been watching the news. Most of the markets are at or near all-time highs. We're at least at average valuations or maybe a little bit above. The market gains for the year have been very narrow, mostly large cap, S&P 500, the largest of the large cap. The Fed is going to be changing interest rates and changing their programs, probably increasing them over time. Europe has significant problems, China, Middle East, and most recently Ebola outbreaks. I think over time it's important when you think about retirement in your portfolio to have a very long-term horizon. So have faith in capitalism over long periods of time. And we have a lot of really great technology and energy revolution happening here in the United States. This slide speaks to asset class returns. Year to date is what I'm going to focus on. So far in 2014, bonds have been very strong returns for the portfolio, and not many people would have thought of that as we started out 2014. Equities, the shining spot has been the S&P 500 or large cap stocks. It's been a very narrow rally, but large caps have certainly outperformed. And you can see small caps and small value are down on a year-to-date basis, and international has also struggled. To give you an idea on Q3 as a standalone, bonds were up in Q3, and the S&P 500 was fairly flat in Q3. But small cap stocks from a U.S. standpoint were down 6 to 7% in Q3. International stocks were down 7 to 8%, probably for small cap value, down 8%. And much of this was to do because of the strong dollar. The dollar increased in value about 7%, which hurts international returns. And commodities were down about 12% for the quarter. Gold was down 9% for the quarter. And overall, in Q3, most clients with diversified portfolios declined probably 2 to 3% in value in Q3 as a standalone. So when you think about corrections and how markets move, we actually haven't had a 10% pullback in the market in over 721 days. It's up to that now. The last time we had a pullback was in November of 2011. The S&P 500 declined about 14% in a 90-day period at that time. And since then, we haven't gone down 10% over a 90-day period, again, in the last about 721 days. To give you an idea, from a shorter term standpoint, over a typical 90-day period, Since 1950, stocks lose money about 30% of the time on a 90-day basis and about 30% of the time on a 12-month basis. So we have not seen that level of volatility in a long time. Here's over here, you can pause and read these, but here's some things you can do to help during difficult periods. Is really make sure you have a focused, well-diversified portfolio, and you're focused on the aspects that you can control. Volatility is part of stock markets, stock investing, and it's why you get paid a good return over long periods of time. So here's a chart of the S&P 500 since 1997, and you can see we've had up, big down, two big recessions of over 50% down. And we're all the way up here. We were just around 2000 very recently in the market, and it's been a great run up to the top. So it doesn't mean we need to go right back down. Hopefully we can muddle through and continue in a longer term bull market. To give you an idea of where we've come from the lows, you can see from the lows of the market, we've been up 250 to 300% for large cap, small cap, and mid cap. From the old highs back in 2007, we're actually up 50 or so percent for the different asset classes, large cap, mid cap, and small cap. So it's been a great run from the market lows and actually back from 2007. Certainly the U.S. market is improving, and we see that in the economy, we see that in jobs and the growth rate. So here's a chart I put together of the S&P 500. Basically, over the last 16 years, went from 1,000 to 2,000 points over 16 years. And you can see that here for the S&P 500. If you invested $100,000 back in 1998, it would have grown to about $297,000. One of the things that we do at Integrity Investment Advisors, we tilt portfolios towards value and small cap. And we do that because over long periods of time, these dimensions give us an extra return and help to grow our money over time. So if you can see the comparison here, this is net of my advisor fee. But basically with a tilt towards large cap, you would have ended up with about 28% more money at the end of the 16 and a half years. And with a tilt towards value and small cap, you would have ended up with 48% more money. And that is net of all my fees. You can see, you can go through line by line, but basically these strategies over here outperformed 11 of the 17 times, but because of the power of compounding, you end up with substantially more money by building a highly diversified institutional class portfolio like we do with dimensional funds. So what I keep telling clients is it's important to focus on what we can control, which is our asset allocation, our goals, reducing the middlemen and costs in the portfolio, diversifying, being aware of taxes, and having a lot of discipline in the portfolio. So we continue to do that for clients, and if you need help, you can give us a call. Again, this is a chart that many people have seen, but it's basically stocks on an annual basis lose money, the S&P 500 about 30% or so of the time. But when you start to look out at rolling 7-year periods, since 1950, over a 7-year holding period, stocks are positive about 98% of the time. So short-term money is invested safely in bonds, and longer-term money should be invested in equities to help fuel your retirement and grow to the level you need to have in retirement. So a lot of people ask, is now a good time to be invested in stocks? And they haven't, and their intent is to time the market. And really over long periods of time, you cannot time the market. You have to be right twice, when to sell and when to buy back. So this slide talks about a 60-40 portfolio. And basically, if you were invested at some other points of crisis, what your returns would have been like. So this is a 1-year return, this is a 3-year return, and this is a 5-year return. And you can see from the crash of 87 to the savings and loan crisis to Asian contagion, .com, terrorist attacks, and Lehman bankruptcy, you can see that over a 5-year period for all of them, they are substantially higher after 5 years. So again, discipline in the portfolio, wide diversification, and investing long-term is the best way to success for your retirement. This slide speaks to, again, we have many ups and downs in the S&P 500. It was positive in 26 of the 34 years, although there have been big drops on average of about 14% or so per year. The last several years, we have not had any significant drops, maybe 5 to possibly 10% back in the market for the S&P 500. So volatility is fairly normal, but the key is investing over long periods of time. Bonds are here to stabilize the portfolio. We're obviously at very low levels of the 10-year bond, probably around 2.3% today here in October when I'm recording this. But the role of bonds in the portfolio is to help during bear markets. And you can see in 2011, bonds were up a positive 9.5%. During the global financial crisis, they were up 15%. During the tech bubble, the other recession, it was up 32%. So bonds are there to stabilize the portfolio during difficult times. As you can see from this slide, bonds have bear markets, and you can see here in rising rate environments, they do lose money, but the losses are fairly minimal by comparison and fairly short in duration. So bonds are there to stabilize the portfolio in difficult times. On the flip side, you can see bear markets and stocks have been about a 50% decline in several of the last two recessions. So again, bonds play a very important role, and it's important to have them in your portfolio for overall stabilization over long periods of time. Thank you very much for your time. If you need help or know of anybody else in your family or friends that could benefit from a free second opinion, let us know. We offer free second opinions for accounts with investable assets of over $400,000. You can give me a call. And again, thank you for your business. If you have questions, please call me, and we look forward to working with you.